All right. What is up, my peeps? Joshua Smith here with another GSD Mode Podcast interview every single week. I interview top real estate professionals, top entrepreneurs, and straight up top badasses that they're dominating their space. And today, guys, we've got another special, amazing, epic guest here on the podcast. So our guest today, guys, is Scott Krone, who's the founder of Coda Management Group, specializes in managing real estate assets, including multifamily, retail, commercial warehouse, multi-use flex athletic spaces, and self-storage. Currently, the platform of investments exceeds $70 million, consisting of self-storage assets. In 2020, co-founded One Step Self-Storage with facilities all across the Midwest. Also is the author of High Performance Homes, Navigating the Green Road to Your Dream Home, which is a book for homeowners seeking to incorporate green technology into their house. So really stoked and honored to have Scott Krone on the podcast. Welcome to the podcast, my friend.
Thanks for having me. I'm really looking forward to this.
Yeah, no, I'm excited, man. It looks like, and correct me if I'm wrong, but reading your bio and reading up on you, I mean, it looks like, your whole life has been really wrapped around real estate, one shape, form, or fashion, or at least, your professional life. I mean, you made the decision at an early age to go to college, pursue architecture. And, if we wind the clocks before that, I mean, was real estate, something that was, part of in the family, or like what attracted you at such an early age to real estate?
Well, I'd say prior to college, the answer to that question was no. I thought I was going to go into die casting because that was our family business. And my parents showed up senior year, said, "What are you going to do next year?" And I said, "Well, I thought I'm going to go into the family business." And they said, "No, you're not. We're selling it. So come up with a plan B." And but I really enjoyed architecture during high school. I took 2 architectural classes, and my dad, suggested that I look into getting a master's in architecture, which was a brand new program. It did not exist before then, because if you did that, you would have to go 4 years undergraduate and then a 5th year to get your master's. Actually 5 years undergraduate, 1 year for master's in architecture, the traditional way. And this allowed us to do 4 years of undergraduate in anything but architecture, and then 3.5 years in a master's program. So a total of 7.5 years to get a master's degree. And so it was only because of that I started getting into real estate, and because my professor was a real estate developer and architect and contractor. And so I began immediately working on real projects with him in school and then in his office because I was his TA.
Yeah. So then did that then continue as soon as you got your degree with the work that you were doing with your professor in those firms, or like, what was the journey after that?
It started while in school. So my master's thesis, which was 400 unit development, was actually something that he was working on. So I'd work for him from 7 o'clock in the morning till noon, doing the development stuff. And then I'd go to class from 1 to 6, working on his stuff. And then I'd go home, have dinner. And then from 7 until midnight, working on his stuff again. So that was, it was 3 years of my my master's degree program was working for him. And then I just continued it when I graduated. I just continued working in his office. So I worked there for a total of 6 years. And then in 98, I started my own firm. So maybe at the stupid age or the ripe old age, or a combination of both, at 28 years old, I thought I knew it all. Ignorance is bliss. And that's when I started my own firm.
Yep. So then at what point did you, make that decision, or really what attracted you to, pivoting from the work in architecture to going in and making that decision? Hey, we're going to go out there now, manage these real estate investments.
Well, when we were, you're sitting there drawing from 9 a.m. The first semester that I had was, I had a month off in between college and graduate school. And then we were drafting from 9 a.m. until 5 days a week. And so, we're sitting all, everyone's in class and they're drawing and drafting and stuff like that. And, everyone's talking about the different roles of architects or developers or contractors and this and that. And that's when I really realized that the developer controls the whole process. The architect is responding to the developer. So, if you don't have a good developer, then the architecture is just creating nice drawings. They don't come to fruition. So I quickly learned, and that was when I got connected to my professor, that him as a developer, I could see the benefit of being the developer as well as being the architect, as well as being the contractor. And then he also had a management company. So I saw the benefit of all of those, and that exposure to it really allowed me to say, okay, not only do I want to just do the architecture, but I really want to be involved in the whole process.
Yeah. So then what was that transition like? I mean, you mentioned that, you made the decision at 28 years old to start the business. And, I mean, there comes a lot of complexities from, having a job to now becoming in those entrepreneurial roles. And, what were some of those big learning and growth experiences that you learned and had to overcome? And what was that transition like?
Well, keep in mind, at that point in time, I was working on a $100 million project, and I was also running a $25 million project and a $17 million project. And so, I had to go to investors to, we raised $100,000 to buy a property, a house, which we tore down. We designed a new house, we built it, and we sold it for $1.05 million. But I had to go to, investors and raise $100,000 in order to do this. And, getting used to hearing no, like that's the thing as an entrepreneur, you're going to hear a lot more no's than you're going to hear yeses. And, one of the things was like, well, how do you know what you're doing? And I'm like, well, I've been doing this for 6 years. I've been doing this, with projects a lot larger. So I had to be in recognizing that I had to have answers to overcome the no's or to overcome the objections. And so, if it wasn't for those first three investors, who knows where it would be right now.
Yep. So then, you then I guess your most recent project is, starting the self-storage business. What led you into going after that niche?
The Great Recession. I mean, everything got destroyed in the recession, right? And the thing I saw was I had one client that wanted me to find him distressed self-storage, and I couldn't find it. And it was very difficult to find one. And so it led me to really study that market, that industry. And I realized how recessionary resistant it was. A lot of people have deemed it recessionary proof. I don't believe there's any proven things in real estate. I think there's things that do well. So that's why I say it's recessionary resistant. And as a result of it, to me, it's apartments without toilets, right? It's just a more simplified version of a box. I've worked on $14 million homes, and I've worked on $100,000 homes. And so everything in between there we've done. And as a result of it, I just recognize that it's just a matter of how much complexity you put into these things. And for self-storage, it's just a simplified box, but we're still renting that box. The difference is it's a retail business. So people are coming in, they're acting as consumers and regularly buying it. So we have to market to them. We have to make it easy in terms of their user experience, all those sorts of things. But it's just a much more simplified version of it. And so for that, there's very definitive statistics that we can see in terms of like saturation, market shares, absorption rate, where supply equals demand that I can't see within multifamily. So that's one of the things that attracts us to self-storage.
Now, are you seeing the same saturation in that space? Like multifamily just seems like it's gotten so saturated over the years. Are you seeing that same kind of saturation, or is there less saturation where there's just more opportunity, but also, as you said, potentially less headaches as well?
Well, I sold off my multifamily back in, I think, 17 or 18, because I thought we were at the peak of the height of it. So I missed that one by a couple of years, but I'd rather be on the front side than the back side. But I think it really depends on the market. Like, normal saturation is 7 square feet of lockers per capita. And what we're seeing in like areas like Florida, the East Coast, is like 13. They're developing at 13 square feet of lockers per capita, or Texas. So we're going after markets which are still below 7, so that we know that there's good supply and demand, more importantly, good demand in those locations. So we're looking for those markets that have under use or under demand of lockers.
Yeah. And then what are some other key factors when you're looking at expanding into a new market, with that?
We look at population, we look at if it's growing, we look at what the median income is. We look at the percentage of renters that are in the market. We also look at how many businesses are in the market. I would say 50% of our tenants are businesses. And so we're really, marketing to both individuals as well as businesses. But, when we look at the median income, then we can determine what size locker is most appropriate based upon the buying patterns. So we look at all those statistics to determine, and zoning as well. I mean, zoning is a huge one, but we look at all those factors to determine what is the best place to go into.
Yeah. Now, I'm just curious with, because right now, the number one question I get is what's going to happen with the real estate market. We're going through a lot of crazy times right now, and none of us have a crystal ball. But most of my experience has been on the residential side, not so much on the commercial side, but we're also seeing a lot of crazy things going in the commercial side. Kind of two different beasts, with that. I mean, when it comes to, the investment side, I mean, and again, understand that, this is a tough question because I know that we don't have a crystal ball. But what are areas that you would stay away from, and what are areas that you see more opportunities in for those that are wanting to actively continue to pursue investments?
Well, I don't like to bash other people's products and industries and those sorts of things, but I'm just going to speak for ourselves that what I have stayed away from. I've stayed away from predominantly retail, and I've predominantly stayed away from office. We are in a recession, right? Last March, I was asked to speak because I was awarded this award for leadership in real estate in Vegas. And what I talked about was how we're going to be entering a recessionary market. And I compared it to 1979, which, interest rates were like double digits and homes were trading based upon their mortgages, not because of the property, but because of, how long was on the mortgage. And if someone had a good 30-year mortgage, that was more valuable than the home. So, I see those I compared to 1979, and I saw a lot of similarities between currently what we're experiencing now versus then. So to me, that crystal ball is, I just look historically at the data, what's going out there. And so that's the biggest thing that I focus on is what have we seen and how does this translate to what we've seen in the past? But I think that's where, housing starts are going to slow down. I think construction pricing is going to become more competitive again because as interest rates stay high, new starts stop. They slow down, which then puts more pressure on construction starts. So I think this will see more competitive pricing. Every time we've had a recession, we've gotten the most competitive pricing for construction. So if you have cash, if you have the ability to get good financing, it's a great time to build.
Yeah. I mean, it's crazy. I'm in Phoenix, and I know right now it's, if you look at like what's happening here, at least in the US, there's different regions, different pockets of what's happening in each different real estate market. But I drive around the freeways out here and I just see, just acres and acres and acres of new build developments, just foundations or half-built homes. And I mean, you're just sitting by the thousands, right? Zero crews out there working. It's just, it is.
Unfortunately, that's a telltale sign.
Yeah. But, so I think some people, I don't know if it is, they just don't want to believe it, or what it is. I don't know who's going to be right on this. But, with everything that I'm seeing, with all the KPIs, with the overall economy, I can't help but believe that all of it's going to be impacted, what residential, commercial, and so forth. And I completely, when you talk about retail and office, like we see what's going on in San Francisco with 50% of the office space just completely vacant, and now this, trend of virtual work, so it seems like it's been a smart move to stay away from those locations for you.
Well, we had a property out in Phoenix, our family acquired in 1973, and we were up on Paradise Mountain, and we'd look east and it was all desert, and McCormick was the boundary of like where nothing happened after, east of McCormick. And now McCormick is, it's now the highway. What is it? Not the 101, but what's the new interstate that it's east of there? I can't remember the number of it, but it's amazing the expansion that has happened there, the rapid growth, right? And rapid growth is also a time when there can be rapid contraction. And that's what we saw in 08, 09. So, it's an opportune, I think it's going to become an opportune time to buy, because you're going to see people that have these half-finished homes or those sorts of things, and it'll be an opportunity to come in and buy those things. So it's where people have taken the most advantage of, is in recessionary markets, is the greatest generator of wealth.
Yeah. And it seems like, speaking of the storage facilities, like I was very, very much so involved in the great financial crisis, building my real estate business here locally, but also working with, top banks and asset management firms. I was the guy having to go knock on the door to deliver the eviction notice, right?
Fun job.
Yeah. But then from there, it's like, okay, well, we had to move their stuff somewhere, whether it was, if they weren't proactive with it and whether we had to get the sheriffs involved and take those to storage units, or they had to move it to storage. It was just like that business, even during that time, as people were having to move out of their homes for whatever that reason, whatever hardship may be, it was just like that, that storage unit, that overall, they just filled up, and so it definitely does seem to be one of the industries. I know that you said nothing's recession proof, but more resistant during those times because people have stuff and they don't want to part away with that stuff and need a place to go out there and store that stuff. What are some of the, overall plus sides that you've seen to self-storage that you don't see in, other investment vehicles out there?
Well, the first thing is we're helping people in a challenging time, right? So if we look at the pandemic and businesses, inventory was incredibly difficult to get. And I don't think we're totally out of that, but businesses would buy something and need some place to store inventory so they could keep their businesses going, right? Because they couldn't wait 3 to 4 or 5 months for a part to arrive. So they load up on as many parts as they could and then have that supply. But people are in transition, right? And so that's the biggest thing that we see is how we can help our clients through times of transition or difficulty. And if we can make that process smoother or easier, then that's the biggest goal that we have at One Stop Self Storage is how to serve our clients to make it as easy as possible for them during their times of transition. That could be displacement. It could be because they have to move. It could be because of divorce. It could be because of death, whatever it may be. Those are the things that we're looking to do. And now people are using their homes entirely different. They're an office, they're a school, they're a gym. And so they need more place to store stuff.
Yep. So then, all right. So speaking of, I'm just looking at some of the talking points that your team also provided me with. You talk about when it comes to distressed assets and investing in distressed assets, to ensure that that investment becomes profitable. And what kind of suggestions and tips, because through this, there's going to potentially become some great opportunities there with where this market is heading.
I think the first thing is, making sure you're buying right. You make your money on the acquisition, not on the sale. So it's important that we buy right in order to, ensure that we're making money. And part of that is the due diligence. And it's hard when we're looking at a property and getting all the figures, what's the income, what are the true expenses, and really going through that and making sure that they pan out and they're accurate. When we buy a lot of properties, we're dealing with a lot of mom and pops and they don't have accurate figures because, if they need something, they pull it out of their business and they just take it. So what are the true expenses? So understanding what the real true expenses of the property and making sure that you get the real accurate rent rolls and also the figures for what the income is, because we've seen a lot of things get way evaluated because of bad numbers.
Yep. And when you're buying these distressed assets, are these primarily multi-unit, whether it be multi-unit apartment buildings, or whether it be or these single family that you're going out there and acquiring?
We're buying actually empty commercial buildings.
Okay, empty commercial buildings. And
then we're converting them into self-storage.
Okay, perfect. Yep.
So, but even then, we want to make sure that we understand all the factors that go into that. Is it clean title? What are the operational expenses that we have there? Are there taxes or whatever that is due, that we have a good understanding of it, and also understanding the zoning to make sure what the process is. So we want to go in and make sure that we have a clean path to get through that process. And so when when we call it distress, it's because it is the building's not being utilized to its fullest potential. So if, like, the building that we bought in Toledo was being occupied, but it wasn't being utilized real well, so that when we took over, we could then convert it and then compare the difference before and after.
Yep. So then, I know that sounds like you're primarily in the Midwest now. Do you have are you plans on just staying in the Midwest, continuing to stay there because it just meets the model so well, or are you planning on expanding, throughout different territories throughout the U.S.?
So, we go Buzz Lightyear, infinity and beyond, right? So we're looking. We began it within a 3 to 5 hour drive of Chicago, and that's how and then as we develop that portfolio, then we'll begin, expanding beyond that as well. So we want to make sure that we can get to the assets easily, And so that's one of the things, right now we're not doing any in California because that's just way too big of a jump for us to go from here to California. But we are looking to expand it beyond just the Midwest.
Yeah. Now, if somebody is, wanting to start in that space, let's just say it's their first investment, they're wanting to get into that space. What advice would you give them? Because I'm sure that there has been, so many learning curves, so many learning experiences, little mistakes that you've had, or maybe even big mistakes, that you've had to learn and overcome. What would be some top advice that you would give for somebody that's just starting out going down that investment path?
I think the first thing is to find really what you want to do, right? So if you want to be an owner operator, then I would suggest buying a Class C. Now, Class C doesn't mean a bad neighborhood. In self-storage, it means first generation, more rural area, smaller, between 1 and 200 units, drive up facility. And we call that more like a penny stock. If you buy it well, you can improve the cash flow and do really nicely. It's like clipping a coupon. Class B would be more suburban, a little bit larger, maybe climate controlled, still drive in, probably 200 to 400 units. And then Class A is over 400 units and fully climate controlled in more urban areas. So if you're looking to be, an owner operator, Class C and B would be good. If you're looking to be a passive investor, then it would be B or A. So really defining what it is you want to do. And then, I'm going to be speaking at ISS, which is inside self-storage, in next month. And we're going to be talking about management and why we started our own management company.
Yeah. Yeah. So, and then what does it look like, and again, just speaking of that first person that person that's wanting to, this is their, first, they're brand new, they're green to this. Well, and hopefully they've done their due diligence and they, know a little bit of what they're doing. But when it comes to financing, what are some, what does that look like when it comes to storage units?
Well, I think if you're a first time and, you could get an SBA loan and it's an existing facility and put down 10% and get a loan for 90%. It's a great program. And there's a lot of lenders that work within that field, within the self-storage and also the SBA. And so, there's some pretty significant large national lenders that work in that field. So if that's something that you're going into, that would be a great way to do it. I mean, SBA does cap you at like $5 million, but if you're buying a Class C or a Class B, you shouldn't have any problem getting an asset for $1 million, $2 million, $3 million. We bought a Class B in Michigan and we paid like $2.5 million for it. And it was 300 units.
Yeah. That's awesome. All right. So then, again, I'm just kind of trying to read some of these, talking points, but you had here, okay, 3 mind-blowing facts about the self-storage unit. So what would those be?
Well, the first one is it's a definitive market, right? It's 3 to 5 miles. So, when people say like, is Chicago oversaturated? That's impossible to say because it's every 3 to 5 miles. So, that's a lot different than if you're dealing with apartments. The second one is that, we have those statistics that we can see what that saturation level is. So we were looking at 2 properties in Milwaukee and they were about 20 minutes apart. One was totally saturated and one was not. We obviously went after the one that was totally not saturated because, that's the data that we look for and refine because we don't want to go into a market that is oversaturated. And so we're really specific about that. The second thing. And the third thing was the operating expenses are typically, 25 to 35% of your revenue compared to multifamily being closer to 50 to 55%. So we just don't have the repairs and maintenance that you see in multifamily. And so it is a lot more efficient in terms of what we can do there. So it's, obviously we want to get everything over to credit cards as much as possible. Like we typically don't receive a whole lot of checks anymore. Certainly cannot cash. When I was at my apartment building, people would come in with cash and, it just was not a good feeling. So we would always want, it's a lot easier to get it on credit cards with self-storage. And then we can also get insurance. We can sell the insurance and administration fees on top of that when they first open up. So there's different avenues for revenue that you wouldn't see with apartments.
Yeah. And then, I got to imagine too, just from an overall staffing perspective, and I have, no idea from, it's not I have zero expertise, from your perspective or your point of view, from the investment side, but, I've got, 2 storage units myself, like meaning, the client there. And it's like you go in there and, it might be, 1 or 2 people that are, just from an overall, staff management perspective, I got to imagine it's a lot less intensive, a lot less headaches,
Absolutely. I mean, in one of our locations, we don't have anybody on site. Actually, 2 of the locations. So, and then the other locations, we have 1 person.
Yeah. Awesome, man. All right. So then, I'm curious about your book. We're going through, this kind of green energy movement. It seems like globally, or at least the West, is going through this, and this stuff is becoming more and more popular, more and more of a thing. I don't know exactly where all of this is going, but it just seems to be everything's moving green. And you hear about some of these big projects, like with Jeff Bezos and turning these, into buying, just millions of properties, turn them into green, efficient, almost subscription style properties. And it just seems to, again, be where things are going with that. So, what led you going down that path and writing that book?
Well, keep in mind that when we wrote that book, the codes were dramatically different than they are now. So in essence, the book is pretty much outdated because the codes have now exceeded it. So the reason why we originally wrote it was because we were doing a lot of this green technology, but keep in mind back then, like in the 90s and early 2000s, fuel and gas was so cheap that it was like green was too expensive to do because the payback wasn't there, right? But like in my house, which won the first green, we were the first green home in our community, and we won the International Green Good Design Award. We were one of 2 homes to receive that in the U.S. My gas bill stayed at $49 for 12 years, and then during the pandemic, my gas bill rose from $49 to $176, but my use did not change. So it was like, what's going on here, right? And the reason why it was always $49 was because that was the minimum amount that the gas company could charge me, because my use was below what they were actually, doing. Regulating it was like the minimum for the meter and all those sorts of things. And so, when we first started this, we were trying to show people, like, as costs are increasing, as the green technology is improving, there are economical ways to incorporate green into your design in order to make your house, you can make it a lot more efficient without having to spend a whole lot of money. And that's the biggest thing that we were trying to accomplish. Now the codes say that we have to be there, like insulation. When we first started, insulation was like R13 in the walls, and I think it was like R25 or 24 in the ceilings. And now you have to be like close to R50 and stuff, R30, depending on where you are. So, the fact that, no one did foam insulation back then. And we were trying to educate people on the fact that if you do foam insulation, you can make your house that much more efficient and that sort of thing. Or if we're, now there's so much more technology with lighting to make it better than, back then it was just, a halogen light was radical, right? And then it became LED and all those sorts of things. So, in our home, what we've done is we looked at the color of the roof to be more reflective. Down in Arizona, your roofs are flat, but you certainly wouldn't want a dark pitch roof on it because it just absorbs the heat. But we did a metal roof, so it lasts longer. We did commercial grade windows with low E insulation. We did foam insulation. Our fireplace burns corn oil. Our cooktop is induction, so it's it's magnetic. And so when we looked at all these things, I use this home as an example of what could be done to show people that you don't have to make it look modern in order to do it. You can make it look traditional. You can make it look whatever you want. But how do we take little steps in order to improve it overall? And that's what's exciting is that, when I first started doing this, the inspectors, like, we were putting in geothermal heating and cooling, and they're having me call the water department. I'm like, why do you want me to call the water department? They're like, well, we don't understand this, so you have to talk to them. So I call them up and they're like, well, why are you drilling wells? What's wrong with the lake water that you're getting from the lake 3 blocks away? Why don't you like our water? I'm like, I'm not drilling wells to not have water from you. I'm drilling wells for my geothermal, and then they had me call the fire department regarding solar panels. because they just didn't know what to do. So a lot of it was also educating the municipalities on, inspections and stuff like that. But now the codes are so much better that you have to build these things into your homes because of where the code is. Like if we renovate a house, a lot of the renovation is just bringing it up to code in terms of the new standards to make things more efficient, to run better and to, conserve energy.
Yeah. I mean, where do you see this going in the near future? I mean, if you look at, the Inflation Reduction Act that just got passed. I mean, so much of that is wrapped around green energy. And again, you see it all throughout the West, but, where do you see this going in the near future?
Well, the current administration is really trying to get away from fossil fuels. And quite honestly, our country is nowhere near ready for that. If you look at the grids right now, we're on the brink of brownouts, especially with the high rise of electric cars coming online. I mean, in California, they were saying, hey, look, you can't charge your cars on certain days, which is like back to 1979 when you couldn't fill up your gas because of the embargoes, right? So we do need to get better improvements. I mean, solar has improved. It's improved tremendously since the time that I put on my solar panels on it. Like when I bought the solar panels for my house here in Chicago, there was not a single rep in the Chicagoland area. They didn't have a representative for the entire state. They're like, that's just stupid. Why would you do that? Right. But obviously in the Southwest, that's a much bigger thing. So, wind turbine is not enough, solar is not enough. Each of these components is not enough in and of themselves. Like I have a friend who's developing clean burning coal so that they can produce electricity with coal, and they produce clean coal burning. And it's this state-of-the-art technology. So I think we have to continue to develop the technology. I think hydronics is going to be really a game changer. The more that we can create energy from water or separating the water, that will be a real game changer in terms of how that happens. But I don't think we're ready to separate, say, hey, we got to get away from gas, or natural gas needs to improve, gas needs to improve. If we can continue, and that's where we get the incentives, I think, from the government, is to develop these and continue to develop these technologies, as opposed to saying we only can do one of these technologies. If we think about, we designed a house for a guy who just bought a Tesla, and he's like, I want enough solar panels on my house to power the Tesla. And I began researching. I was like, it's going to take 3 days of 124 hours of sunlight to charge your Tesla. 3 days around the clock. I go, that's how much power it's going to take. I just can't put enough solar panels on your house to do this, especially when there's trees. Trees cast shadows, and shadows don't do well in solar panels. And so he's like, well, give me as much as you can. But that was his perception, was I'm going to have an energy car that's, electric car, and I'm going to have solar panels charge it, and I'm going to run it solely off the solar panels. It's just not possible. It's still not possible. It takes an hour to charge a Tesla, which is a lot of time in terms of how much energy is actually used to generate that electricity, right? You have to create that energy, and it's still expensive on that backside. So the more we can become efficient, the better we can come at that overall technology. I think that's where we're going to be able to see that transition, if we become all electric or all hydro or whatever it may be. But I think, we still need to be investing in all of them, not just one. We can't put all our eggs in one basket at this point in time.
Yeah. 100%. So then, what you mentioned earlier about, cost of construction coming down with the climate that we are in. So I mean, because one thing that is worries me, I guess, if you will, is if we continue to experience what we're experiencing. It's like, okay, the last couple of years got to the point where the average first-time buyer here in the U.S. is now 37. And I'm sitting there looking, well, man, I've got young kids, and the American dream, may not be a lot unless there's some type of deflation that takes place, that hits. Do you when it comes to the overall market, I mean, do you see us entering another deflationary time, like we saw during the great financial crisis, where it makes real estate affordable again, just for the average consumer out there? Because like right now, I mean, And again, a lot of those are watching and listening, including myself. I mean, we're out there representing so many clients, and whether it be investment properties, but a lot of just traditional buyers and sellers. And, we're experiencing this all-time low affordability all throughout the country. Stack on these, crazy interest rates and so forth. It's, it's like something needs to happen, when it comes to a correction in those prices. Otherwise, it's like, hey, we have the Italianification, I guess, of American real estate, which, we're seeing. I mean, we see like Lennar going out there and building multi-generational now floor plans, where they're set up where there's, 2 kitchens, 2 living quarters and under one roof. It's not a full-on duplex, but it's, set up for multi-generational living, where it's like, okay, are we going to go down that path? And again, I know none of us are certain on this, but based on your thought process, I mean, it sounds like you've done a lot of research on this, where do you see this heading?
Well, keep in mind that the biggest reason why we're in this is because of our massive spending that we did, right, in order to withstand the pandemic and then the implications of that pandemic, right? And so it was unprecedented spending. So we had massive inflation. Now, this is an argument that we have in our office all the time. I'm like, a lot of that inflation is figment. It's an arbitrage, right? When I put the geothermal in this house, it was $20,000 for the equipment, installed. We're now looking at prices that are like $26,000 for one of the units, not 2 of them, just one of them. So how is it that the price is that high, right? It's just that there's an arbitrage there because of the fact that people can demand that pricing. And why? Because there was a shortage of, everyone blamed it on the shortage, and they also blamed it on the cost of labor going up. Well, if the cost of labor was that skyrocketing, then why are people complaining about $4 or $5 a gallon of gas? Why are they complaining about the cost of food? So my argument is it was not going to the laborers. It was not going to the employees. It was going to pad the pockets to overcome what was going on in the hardship. So the first thing is, as construction slows down, we're now hearing subcontractors say to us, what number do I have to do to get this job? Because I have to keep my trades going. I have to keep my guys going. That's a sign that the market is slowing down. When subs are, willing to take a job just to keep their trades going. That's what we see. That's what I saw during the great, after the crash. That's what we saw a lot of times. I mean, I've been through 4 recessions. And that is a common phrase during each of those recessions. What do I have to do to keep my guys working? That becomes the primary focus. So, that arbitrage is going to disappear as people need, and that's going to be the biggest factor driving the price down, right? It's basic supply and demand. But the reason why we had to jack the interest rates was it was the only tool that the Fed had in order to stop the inflation. The higher the interest rate, less willing people are going to be willing to invest in things. And so that was literally with the amount of money that they were printing, the only tool that they had at their resources was to raise interest rates. As the economy begins to stall, then the only tool that they're going to have to free it back up is to drop the rates. And that's then going to spur economy. Now, keep in mind that since the crash, 08, 09, we've had the fewest housing starts ever. And so there's this huge glut of housing, which is forcing more people to stay in apartments, which is then raising the price of apartments. And then, was making it harder for people to buy new construction because prices of homes were escalating so quickly. So now with interest rates higher, people can't afford as much. So those prices are going to come back down. And what we really need to do is get housing starts to go back up again. That's what's going to, begin switching this lever that you're referring to. So it's a complex problem between interest rates, housing starts, and construction costs, but it's all dictated based upon the monetary policy of the government. Now, if I look historically what's happened, and I said this before the last election, so don't hear me as being Democrat or Republican or whatever. I'm just looking at historical, right? We gave every president 8 years to screw it up. And then, the first year, the first, term, we'd automatically renew them and give them 8 years total. And we were basically bouncing back and forth between Republican and Democrat. The sole one was Carter. The economy was so bad, every state voted Carter out except for his home state of Georgia, right? And that was the biggest landslide with Reagan came in, and Reagan just automatically changed the monetary policy, and the economy began taking off immediately. And I said this before the last election. I said the only reason I think that Trump will lose, because we give every president 8 years, is if something financially happens in the marketplace. And the pandemic sort of caused that. It was somewhat of an issue, but he was voted out. Now we're experiencing a worse economy since that period of time. So what I'm predicting, my recession is based upon the political cycles. If we continue to experience this, people are going to have enough. And then I think that there's going to be a change, and that's going to change the monetary policy. And then we'll begin seeing it. So my prediction is in 3 years, 2 to 3 years, I think we'll be in this recessionary market, because they can't change the monetary policy. And then we'll change administrations, and then we'll go forward.
Yeah. Yeah. And it's crazy what we're seeing right now, with the banks and the liquidity crisis and things that are taking place there. How do you see that impacting? It probably impact more the commercial real estate market more than the residential side, but with everything going on there, again, liquidity issues that's taking place, do you see that impacting anything on the commercial real estate side?
Sure. I mean, it creates lack of confidence, right? I mean, it's what Jimmy Carter was classic for saying. Right now, we're experiencing a crisis of confidence. And that's what, every bank, every investor wants to have confidence that they know what's going to be happening, right? At least know what the path is. And I think what happened at the last, bank run was a combination of three factors. One was the interest rates rose so high that they had to sell. And then they called a capital call at the same point in time. And it was a combination of those two factors which created the run. So it was a little bit of timing. It was a little bit of mismanagement. And it was also, they weren't necessarily doing anything wrong. They were a profitable bank. It was just a combination of those factors, which led people to have a lack of confidence, which then created the steamrolling effect. And I think, people have an itchy trigger right now, right? They want to, they're edgy, they're quick to make decisions, as opposed to like, let's see what's going to play out here. But in that case, they didn't want to risk it because they thought they'd lose their money. But I think they're going to get 90 cents on the dollar back on their investments that they had in that bank. So I don't think it's, was it as severe as it was reported? Maybe, maybe not. But I think that, if it was more severe, like in 08, 09, one bank went, Lehman's went, and boom, the entire market came down. So we're in an entirely different, situation than 08, 09, because we don't have the massive truncation of debt on top of debt. That was more about how the bank was run versus the underlying principles of it. I mean, they had very conservative backings in that bank, and it wasn't like they were leveraged to the hilt. I think they had like 40 or 50% leverage. I could be wrong, but I mean, they certainly weren't leveraged up like 90%, which was, in 08, 09. Yeah.
Yeah. So, all right. So here, you talk about, again, just referencing your talking points, 4 proven passive investments. And one of the reasons why I want you to hit on this is, so much of our audience, again, attached to the real estate space. Well, when I say real estate space, real estate sales space, and it's like, look, we don't have 401ks, we don't have pensions, we don't have, so if we are not smart with, going out there, selling a lot of homes, let's just say, earning that money, and then being smart with our investments and don't have a wealth strategy for that, well, then at the end of the day, we're left with nothing. And unfortunately, a lot that are in this industry follow that path. So when you talk about 4 proven passive investments, just really curious on what those would be, for those that are watching, listening, of just to identify what that potential wealth vehicle may be for them.
Well, I mean, the first one that I did, which the vehicle still exists, but you have to be a little bit more creative on it, is, and I tell the young people in my office, I'm like, if you can find a distressed house, okay, when I say distressed, I'm saying it's well below market. I'm not talking about foreclosure. I'm not talking about anything along those lines necessarily. It could be, but like a house that is well below market needs, right? And if you find that, and you can change the program. So what we did is that we would buy a property, fix it up, live there for 2 years, and get the cheapest mortgage we could. So interest only for like a 3-year arm, whatever it was. So basically I was paying rent. I was trying to pay rent to myself. And then I would flip the house. So if you can buy well, I mean, I bought a house that was destroyed by fire. I bought a house that was a barn. I bought a house that, was a single story, and I put a second story on it. But what we were doing is every 2 years, that income that you make on it, up to $500,000 if you're married, is tax-free. And so you can use that money to invest in other investments. You can use it to pay off college. You can do a lot of different things. So if you don't mind moving every 2 years, it's a great investment vehicle. And I don't think enough people really take advantage of that. I mean, it is hard to move every 2 years, but we had a strategy, keep it lean. And then if it didn't get unpacked, then guess what? We got rid of the box the next time. So, it just kept us more lean. So that was something that we did like 7 times. And so that was how we generated wealth, was just flipping homes. And we did it with a condo, and then a condo, because we bought the condo pre-construction, so that by the time we moved in, it already appreciated. We did that again. And then we bought a 1-story house. We put a 2nd story on it. Then we bought a house that was destroyed by fire, built a new house, and we bought a barn, built a new home. And then we moved into the our current one. So those were the things that we did. That's one strategy. The second strategy is really making sure that when you're buying, you understand the product that you're buying, whether that be, a lot of people say, well, I want to get into 2 flats, or I want to get into, a duplex or something like that. It takes more time and energy on a duplex than it does 20 units. So if you're going to do it, build up your resume, make sure you have your credentials, but don't start real small, because it's actually harder. Those projects are harder to do than, if you're doing 20, 100 units, because of the fact there's economies of scales. You're going to spend as much energy on that as you are. We looked at our KPIs, and what we saw was, like, for us to do a renovation would take as much time, more time than a new construction house or a conversion of a self-storage facility. And we would make a fraction of the amount of money on it, because how much time and energy we spent on it versus the profit margin in it. So we're not working on projects that are much larger, that we spend about the same amount of time, but our profit margin is much greater. So really look at your KPIs to see where it is. So if you're planning on living there, that's one thing, but otherwise, get your backing, get people behind you, make sure that you have your numbers and your experience all well, and then go after something a little bit bigger, push it. Don't necessarily start with something small, because, the profit margins are a lot harder there. The third thing is really understanding your product. I mean, that's like how we got into self-storage. I think self-storage is a great one. And if you're looking to go into it, then, determine if you're going to be a Class C, Class B, or Class A, and how you want to invest in it, and making sure that there's good economics behind it to support it. And then I think the last one is to become an expert in your field. People are going to, be more willing. My mentor said there's a difference between being a pro, an expert, and the authority. Okay, so a pro is someone like a plumber. It's a professional. They do it day in and day out. And then the expert is the best plumber in the neighborhood, and the authority is the best plumber in the entire area. So if you think about it, if you're going to have brain surgery, do you want a pro doctor doing brain surgery? Do you want the expert, or do you want the authority? Obviously, we all want the authority and pay the pro prices, right? But, if you're going to do it, then do it all well and become the authority in your marketplace, so that you really understand what's happening in your marketplace. Study your marketplace, because, that's why I go back. I mean, my undergraduate was in history, so maybe I geek out on the history, but that's why, when I saw trends happening, like in the internet bubble, the housing bubble, I stopped buying, because I saw what was coming, and I stopped buying properties. And that's when everybody else was criticizing me for selling when I was selling. And they complained that I sold too early for too little. But when those bubbles hit, I wasn't sitting on a lot of inventory. And that's why it's important to really make sure that you study your marketplace, because whatever it is, then if you're the authority in it, then you'll understand it a lot better, and you'll have a lot less risk.
Yep. Love it, man. So then, looks like you're also involved in self-storage investing on blockchain. Can you elaborate a little bit on what that looks like and what that is?
This is the next gen, right? For those that might not be familiar with blockchain is a contract that it gets facilitated when everything comes together. The transaction is enacted. And so when all the requirements come in, and then that transaction is dispersed, and then that file is sent out over the internet for security storage. I think blockchain is going to be replacing title companies. I think the technology, maybe not replacing the title company, but the title company is going to be relying upon the blockchain to facilitate transactions. I really think this is one of the more revolutionary components of our industry, is how blockchain is going to become an everyday occurrence within real estate transactions. And part of that, when you have a blockchain, what's created is the coin, right? And so we've created a store coin and the blockchain behind it in order to facilitate both real estate transactions for self-storage, but then also for our clients to be able to pay and utilize that coin in terms of their daily transactions. So it's another way of how we can make the process easier for people. And we're working with a conglomerate of other self-storage operators that if someone is moving from Pittsburgh to Chicago to wherever, Michigan, and we're in the store coin, STOR coin group, they can then transfer seamlessly between one facility and the next. And so that is where we think we think real estate is going, is blockchain, and the byproduct of that is coin. And that is where we see as another way for people to invest and take crypto and invest in tangible assets.
Yeah. Yeah. I mean, because you even look at like just the county recorder's office. I mean, so much of this is just so archaic, and just the amount of efficiency and reliability that can exist, with the blockchain. So, I agree that it's all going there. Now, do you see, I mean, we're seeing a lot of moves right now with the government and executive orders, and, when it comes to just cryptos in general and all this talk of CBDCs, do you see, I mean, is that just talk, or is that something that you see becoming a real thing? And, almost seems like because now, okay, if you look at like they say, Bitcoin, well, if there's a CBDC, that's almost competing currencies. What does that conflict look like? I always wonder, okay, are they going to allow that are they going to allow that competitor to be out there, at least here in the States? How, I mean, do you see that stuff rolling out? And if so, how do you see it having an impact on these other coins? And, I guess everything when it comes to.
Yeah, I think the big thing is that the government is trying to figure out, one, like how to regulate it and then how to tax it, right? I mean, that's ultimately what the government wants in any business, is how we can make our money off of that. So I think there is going to be more regulation on it, but keep in mind, we definitely have different currencies already right now. So people are trading on different currencies to make money. So I don't think that they're going to be able to eliminate different coins, but I think there's going to become a standard. And that was one of the things that I always struggle with as an investor, is like, okay, let me get this straight. If someone is mining this coin, then what's it tied to? What's the monetary policy that it's tied to? That, if you just keep creating more and more coin, then what happens? Your initial asset is devalued because it's flooded with more dollars, which is what we're seeing in the current economy right now, right? We printed more money, so we saw inflation going up. So I think that was always, for me, the struggle of understanding how crypto tied into the overall economy. And I think that we're going to have to see these things being tied back to a monetary value if they're going to be traded in the marketplace. And so I think that's the reason why the government is trying to get a handle on this, in terms of what is the consistency for that. So if someone is trading on the store coin and they have Bitcoin, then they're going to have to convert it to store, and there's going to be a transaction factor. Is one Bitcoin versus one store coin, or is it 2 to 1? Just like what we're seeing if it's going to Canada, right? There's better times to be in Canada than there were in the United States. So I think that is what they're trying to regulate, is that conversion rate.
So is the store coin that you guys have created, is that then backed by the storage facility assets themselves?
Well, yeah. So the investor that has crypto will be able to convert it into store, and then they would be able to invest it into the real estate. And then the performance of the coin is generated by how well the overall portfolio does of self-storage facilities.
Yeah. So that your gold is the self-storage facilities and how well the assets are performing.
Correct.
Yeah, that's awesome, man. That's awesome. All right, so then, one thing that is difficult for entrepreneurs, we can get obsessed with business, but then we can let other balls drop and other aspects of our life that are important to us, and it can happen unintentionally. And but I know one of your talking points was how to live a full life. So how would you define that? And what advice, I mean, what does that mean to you, and what advice would you give to others? Because again, we can get so obsessed when it comes to business. It can be so consuming, and next thing, boom, our health goes, or our marriage goes, or, I mean, we've all seen it. There's somebody that's created massive success in business, but they're on their fifth marriage and they don't know their kids and they've lost their health.
Sad stuff, right?
Yep.
So for me, I just finished, 2 weeks ago, I just finished a 2.5-year program called the Transforming Center, which focuses on leadership. And, the first quality, we did quarterly retreats, all focusing on how to become better leaders in our businesses, in our families, and our whatever we're doing, right? And, the group of people that were involved with this was a wide range of people. But for me, it was like, how do I focus on what I'm learning there and apply it towards not only my business, but my life? And the first thing was an understanding, like, dangerously tired. When is the need to pull back, to have a retreat, to assess, to breathe, to rest, to relax, to unplug? And, what are the characteristics of being dangerously tired? And can we identify that and recognize that? And I don't think that a lot of people take the time to stop and evaluate how tired they are, and if they are dangerously tired. We're starting a new venture right now, and I've been, working 60, 70 hours a week just to maintain and develop this program. But I recognize, hey, I'm dangerously tired and I needed that retreat. And so a part of that retreat process is silence and solitude, where we totally unplug the phones. It's a 2.5-day thing. And, in a lot of that time, we're by ourselves with no stimulus other than, if you need to take a nap, you take a nap. If you want to go for a walk around the lake, you go for a walk around the lake. But how many times do we have that ability just to unplug? And for me, one of the things that we always do every morning is we start our morning at 5:30. We get up and we're heading to the lake. To us, that's our solitude and silence retreat every day. And, for 8 months of the year, I'm paddleboarding out on Lake Michigan. We do that from like April through November. And, when you're out on the lake and it's silent and solitude, it gives you the ability to think and just relax and breathe. And, finding that routine, finding that pattern that you can do in your own life to pull back, to unplug and just recharge, right? And I think for me, that's when the creative juices really flow. And that's when I begin to understand, okay, how do I solve this problem? And I get a better reflection of it, because there's no stimulus interrupting my mind. It's just out there being quiet. It's a beautiful thing.
Yeah. Yeah. So then, can you maybe go a little bit deeper into how to identify the statement they made was how to identify when you're dangerously tired, because in the business world, and all of us that are watching, listening to this are entrepreneurs, I think there's a lot of pride in our work ethic. It's a lot of our identity, but then also, there's that whole hustle grind, and again, that gets wrapped up in our identity, and you get operating at so fast. I mean, how do you be able to identify that? Because, a lot of us too, it's like, we love the grind, like, I'm personally one that, like, dude, if I'm working 40 hours a week, I don't really know what to do with myself. Like, I feel best when I'm, but there is that balance there of not overdoing it, because you get a negative return on that time, like there's going to be a point where it's, I can't really think of the term there, but,
Diminishing returns.
Yeah. Diminishing returns on that time, so, what has worked for you to be able to identify that, where it's like, okay, this is that moment where now I'm getting that diminishing return, where you maybe do need that full retreat? Yeah,
I think that the first thing was the concept, understanding the concept, right? And someone pointing out to me like, hey, what you just described is not, not typical, right? And granted, I when I first started, my job, the first company I worked for, we were mandated a minimum of 60 hours a week. And then when I went full-time, then he implemented 80 hours a week. So, I was making like $1.25. And guys were literally falling asleep on the toilet. We're like, hey, he's been in the bathroom like a long time. Like, someone better go and check on him. And sure enough, the guy had passed out on sitting on the toilet seat. But the first thing, when I went to the retreat is recognizing, hey, what are the symptoms for this? And one is like, are you short? Are you seeing that you're not making the best decisions because you're just reacting to every emergency, right? And those sorts of things, and being able to say, and that for me right now is like this past weekend, I recognized that I was getting very tired, and I just needed, I literally did nothing Saturday night and all day Sunday, and for me to recharge. And it was the time of like, I got to cut everything else, because leading up to that week, I had a full week, and then we're host parents for these 3 boys from Africa at Northwestern, and it was their spring break. And I told them we would do something every night, and every single night we did something to check off their bucket list. And I knew that it was going to be an action-packed week, but I also knew like after that, I'm going to need to take some time really to recharge myself, because if I don't invest in myself, then I'm just going to go into the week. So am I not sleeping well? Am I not eating well? Am I not feeling well? It's like if you take a glass and you stir it around and you see all the sediment, but a lot of times that sediment just floats to the bottom. We don't realize how much we're really carrying around with us. And I think that that's the thing that we have to recognize is, what are we doing in our lives? That are we giving ourselves the ability to breathe? Are we giving ourselves the ability, time just to pull back? I did a program with Jesse Itzler, and he broke it down into hours. He's like, I'm going to have 8 hours of sleeping. I'm going to have 8 hours of work. And then I need 3 hours a day by myself. I need 3 hours to invest in myself. And that was his way of identifying, how to create that alone time, to create that the recharging time for him. And, the first step is just identifying, am I giving myself the ability to do these things? And if I'm going from one activity to the next constantly, and there's stages of your life that happens. I mean, we're now entering a new stage of our life where we're empty nesters. And so, I could work more, or I could do other things more. And so, because I don't have the responsibility of kids anymore, on a daily, minute, hourly basis. But so the first step is just being able to recognize it, breathe, and then seeing how can I pull back? What can I do that will allow me to charge? Is it going for a walk around the golf course? Is it going, whatever the activity is? For me, part of it is painting. I have a season of paintings, after the Super Bowl and before sailing starts, that's my painting season. And that's for me recharging, just sitting there painting something. And my kids were like, Dad, I want this drawing for this. I'm like, it's not painting season. You're going to have to wait.
Yeah. What has been the key, for you with building all of this and creating all this amazing success that you created while managing a family? Because that's a challenge. I mean, I've got 3 young kids and multiple businesses, and I find it challenging. I know a lot of others do as well. But obviously, you've been able to also build these amazing businesses and have a lot of career success while, having a family and keeping all these pieces together, if you will. What has been key for you to be able to balance all of that and still go out there and hit the, amazing successes and accolades that you have?
Well, I think early on, I didn't know how to balance it, right? So I'd be constantly on the phone while in the car and stuff like that, because I thought I could be productive. And there's trade-offs to that, right? I mean, the benefit is that I could conduct my business while driving my kids to hockey, or taking my computer and the technology with us. We were very first early on to have a server we could access and work remote. So going remote really wasn't that much different from us during the pandemic. In fact, because we already had the tools and everything all set up for it. But I think the big difference is that as the kids got older, I realized that I needed to have time where I was just focusing on them and not being interrupted by a phone call or whatever it was. So for me, it's like if I'm during those business hours and we're traveling, then it's business. But once it's done, then I'm turning it off. I'm unplugging. And I'm really focusing on them and giving them my interest and my time. And that's the benefit of being as an entrepreneur or business owner, is that you can set those times when you want that. So if I need to do something with my kids at another time, I can make it up some other time. So that is the benefit, but the trade-off is you really got to be disciplined about it. And it was actually much harder when I was working from home, because the switch was right. There was no decompression time. There was no transition from being in the office to walking in the house. It would be literally from walking from one room to the next, and I would still be worked up over something, right? And then it was harder for my kids. So I think actually for me, it was more advantageous to have an office outside of the home to allow me to have that ability to transition back into the home life. I found that to be much more a better situation than working from home.
Yeah. And then, I mean, you've got multiple different businesses that you're simultaneously managing as well. And new growing businesses and growth, expansion, all of those things. What has been the key for you to be able to manage multiple different businesses simultaneously?
Well, the underlying systems. I had a situation where an unfortunate relationship with a business partner that was not the most forthcoming in terms of how he dealt with business and the finances side of things, which caused a split. And it's at that point in time, I recognized if I was going to grow my business, I needed to have better systems in place. My systems caught it, but I needed to have more consistent systems in terms of developing it. And my mentor, I've had two major mentors in my life. The second one is Dr. Nido Kubain, who's the president of High Point University, and immigrated here from Lebanon when he was 16 with a couple $100 in his wallet. And now he owns Great Harvest Bread and Lazy Boy, and he's on the board of BB&T, and he's the president of High Point University. And he's been managing all those. And then he's been able to invest $2 billion into High Point University to expand the campus by over 1 million square feet. It's just incredible transformation. So whatever I've done is like a fraction of what this guy has done, right? And but one of the things he said was prepare your business to be able to sell it. So that goes back to one of the 4 principles of, and I forgot to mention this, is how am I preparing my business to be sold? So every time I'm doing something, I'm looking for the end game of how I'm going to sell my business. And so the better systems I have, the more repeatable systems that we have, then the easier it is for me to manage. So when we just started a new venture, like I just pulled over all the systems. So in the people that were joining with us, like, well, this is amazing. Like I didn't realize you had all these things already in place, but that they're like, now we get why you were able to expand from just being in a small suburb of Chicago to across the Midwest was because those systems, those underlying systems were in place. We spent a lot of time developing those, and we spent a lot of money developing those. And part of it was I figured I could either invest it and do it myself, or I could spend the money and buy someone else's system. So we did a combination. We created some systems, but we also bought other people's systems to make sure that everyone is on the same page.
Yeah. So then, when you have these multiple different ventures that you're involved in, do you find yourself at this point in time being kind of more pulled to one than the others, where you see that being more of the long-term path where, hey, maybe I exit from these others, or maybe not even exiting from the others, but that you just see yourself being pulled more towards?
No, I think when we were having internal conversations about this in our office about the new venture that we're beginning, and I can't really get into it right now, but the idea was that we're only going to do this if it's going to complement what we're already doing. If it's something that is going to benefit what we're currently doing, then we're going to do it. If it's not going to benefit, then we're not going to do it. So everything has to have a congruency to it, so it grows the overall portfolio. Does that make sense?
Yep.
So I'm not going from like, people say when I get in real estate, I want to be a wholesaler. I'm like, well, why do you want to be a wholesaler? I'm like, well, that's what I was taught I had to do in order to become a flipper, and then a flipper would lead to this and then that. And my point is, if we're going to do something, it's because it's going to add to it, not because I have to learn a trade or a technique. I can buy the technique, I can buy the service, but more importantly, I want to make sure that it's going to add other additional revenue to what we're doing, and it's going to build the overall portfolio. So that's the biggest reason why we do something new, is not because it's a new shiny squirrel or coin out there. It's because it's going to add to what we're currently doing.
Yep. Love that. So then, Scott, for those that are watching and listening, I got one final question for you before we get into that, though. For those that are watching and listening, if they want to continue following you on the success journey, maybe they want to pick up your book, and again, just following on this amazing journey that you're on and check out more of what you're up to. What is the best place to follow you, to check out everything that you've got going on?
Well, I appreciate it. And if people reference this show, I will hand it to you. You're one of the most thorough podcaster interview I've been on in a long time. So I really appreciated the depth to which you've gone in here, and I've really enjoyed our conversation. I hope it's been beneficial for you as well. But if your listeners want to learn more about self-storage or why we do it, and they reference this show, if they email us at info@codamg.com, we will give them two things. We'll give them one, a feasibility report, which not only explains why we bought it in a specific market, but it will also talk about the overall general market of self-storage. And we'll also give them a self-storage deal analyzer. So that way they can compare it to multifamily. So we will give them those two resources if they mention this show. And if they have a property, we're happy to talk with them. We'll sign the non-disclosures. We're not looking to steal anyone's properties. The world is too small for that. I'm not into just making a quick buck and screwing someone over. That's not our business model. So if someone wants to talk about a property, we're more than happy to run some quick statistics for them and say whether or not we think that they should go into it or not. I'm happy to do that. So those are the two different things they can do. They can look at us at codamg.com, or they can follow us on onestopselfstorage.com.
Yeah. Now, are you just, with that, are you guys doing, just primarily focusing on acquisitions on your own side, or there, potential partnership opportunities or investment opportunities that you guys are also
both those things?
For?
The way in which we set up our business is that we're, if we look at the true progression of it, we were a design, build, development firm, and then we became an asset management firm as well. And then we become a management company for those assets. So there's a real progression. So we haven't, again, all those congruencies, right? So right now we're doing a partnership in one of our facilities because the people came to us and said, we own this building, but we don't know what to do with it. We want to make it self-storage. Can you help us? Other ones have hired us just to do that. And then other properties we've bought on our own. And so those are the things that we look at, all three of those things.
Yeah, awesome. And those that are watching and listening, as always, if you just scroll below, whether in the description of the show notes, we'll have all of Scott's contact information, all those links right below. All right, so I know we're going long on time here, but one final question for you. So if Scott today, knowing everything that you've learned throughout this whole entire journey, could go back and have a conversation with your younger self when you first entered into this space, and just give yourself a couple pieces of advice that you just feel would have, if you wished you would have known, that would have fast forwarded the success trajectory that you're on, what would those pieces of advice look like?
Could be a head slap on the back of the head.
Yeah.
I think the first one would be patient. It's funny because when you're 28, you think everything's just going to be passing you by. It's the FOMO, right? And you see all at that point in time, housing market was exploding. People were making tons of money on stuff, and you didn't want to be left out. Now, when you look back, and it was like, man, how much did I not know? Just be patient. Don't rush things. Just take time, breathe, and recognize what it is. So that would be the biggest thing I would say to myself is, especially at a young age, it's like, you don't have to, prove to everybody that you know everything at 28, I still don't feel I know everything, and I'm, much older than 28 at this point in time, but I wish I had a lot more patience back then.
Yep. Love it. Powerful stuff. And Scott, again, we truly appreciate you taking time out of your busy day to be here, man. This has been a lot of fun and been a huge honor.
My pleasure. Thanks for having me. I've really enjoyed our time, and I thought your questions were fantastic.
Yeah, truly means a lot, my friend. And those watching and listening, as always, truly appreciate you being here, watching and listening, and truly appreciate all your support. Keep crushing it, and we'll see you next time. Peace.